Welcome to Subramani. One old saying in investment is you get rich by concentrating, and once you have got rich, then you need to diversify your portfolio. Now, this is true for a lot of people because whoever has got very rich has got a very concentrated portfolio. For Warren Buffett, it had to be Berkshire Hathaway. For Bill Gates, it has to be Microsoft. For Mukesh Ambani, it has to be Reliance, and for Mr. Azim Premji, it has to be Wipro. That is how they have created this huge, humongous wealth. There is no doubt about that. But once having created this wealth, then you need to diversify to make sure that you stay rich, right? If something were to happen to the main company, so then what happens? So all these people have diversified enough from their portfolio, and they have assets other than the main company which they own, and that is the way they reduce the concentration risk. When I talk of concentration risk, understand one thing, that concentrating your assets in any asset class, doesn't matter whether it is equity, debt, gold, right, silver. We have seen all these things go and bankrupt people, right? I don't remember those brothers who ran up the silver market, Hugo brothers or Hugh brothers, somebody like that. I'm sorry, but I don't remember the name. I'm talking from memory. So they ran a risk of concentrated risk in silver. Similarly, you could have run a concentrated Japanese portfolio and be ruined from 1980 to 40 years to recover, or maybe more, and not yet recovered. You could have run a concentrated LTCM was a proof of concentrated risk, saying market cannot go below a particular price, right? And then that's it, the LTCM got wiped out. Similarly, can you run a risk of having treasury, right, just treasury bills? Is that a concentration risk? Well, it happened in case of SVB, right? SV Bank in US, California based bank, which went bankrupt because it had a concentrated portfolio of treasury bills. But the worst thing that they did, and the stupidest thing that they did, which our RBI will not allow, I have no clue how Fed allows, is they were not doing a mark to market. If you were doing a mark to market on a daily basis, you could never have gone bankrupt, right? So this bank, which is bigger than HDFC Bank, went bankrupt because of a concentrated risk and not doing an MTM. Sorry, here not talking about MTM, we are talking about concentrated risk. So I have friends who come and tell me, look, I've got so much of HDFC Bank, I've got so much of HDFC securities, and I'm going to get so much of dividend. Is that good enough to retire? The answer is no, it's definitely not good enough to retire. You cannot retire with such a concentrated portfolio saying all my dividend income is coming from one or two companies, right? What happens if something goes wrong? So you have to diversify your portfolio and make sure that, especially for people with ESOP, that not more than 20% or 15% of your portfolio is in one single stock, right? So if it is there, you have to keep selling. It is ruthless, but you have to sell, and I have done that in the past. When you buy a share at a particular price, it is, say, maybe for me, let me use the numbers which I use. 2% is the minimum that I would buy, because if I'm buying less than that, it's a morning evening kind of a, or a BTSG kind of a position, which is not taking a investment position. An investment position has to have at least 2%, right? So that is the minimum I would go to. Then slowly I would go up to 5%. Then when the price expands to maybe 10%. 10% is still comfortable for me, but the minute it is 15%, I start getting fidgety. I keep wondering what to do. I sell off little bits, and I'll have some kind of say mental threshold. So let's say it is Cholamandalam, and I would think it's now the price is 1,900 or 1,000. So then say, okay, 2,000 I'll sell off 100 shares or 200 shares. Does not really move the needle at all. But I keep doing that. I keep selling, and I don't buy it back when the price comes down. Even if the price were to come down, I'm very happy paying the capital gains and going to back to my portfolio. Now take the case of what would have happened if I had bought 100 shares of Wipro in 1980. Assuming all my other investments put together was worth 1 lakh. This I had put 10,000 rupees in an IPO, and it got listed, and it got listed at 10,000 rupees. Till that time I'm fine, right? It is 10% of my portfolio, which itself is high. So let us assume that my overall portfolio was 10 lakhs and not or say 20 lakhs. Make it even a crore, doesn't really matter. Even at crore, it would be just about 1% of my portfolio, and that would be very comfortable. Slowly the price increased, the price went up. I mean, my total portfolio remained at 1 crore, but then this went from say 1 lakh to 2 lakhs. I'm still comfortable. It went say from 1 lakh to 10 lakhs, and my other part of my portfolio did not move up, and it was at 1 crore. So now I'm at 10% of my portfolio, that's still okay. Then it goes to 15% of my portfolio, 15 lakhs. To me, that is panic button. I would have hit the panic button and said, this is too much, I need to sell Wipro, because the other part of my portfolio is not doing well. So please remember, when the other part of your portfolio is not doing well, you will have to do something. You will have to say, I have to reduce concentration risk. So either I make my other shares, so suppose the other shares were Silverline, Pateja Forging, Indiana Dairy, and all those kind of companies which are today not even visible, right? So I was losing money in the other part of my portfolio, and other part of my portfolio came down in value. Would I have sold that? Yes, but it wouldn't have fetched me much money, right? So I would have moved a little of all my kachra into cash, which I do very normally. You end up buying some shit which is not moved in 6 months, 8 months, 1 year, and then you say that's enough, I can't wait permanently. Then you get out of it. You lose patience and get out of it, or you look at the numbers again and again and talk to people and find out, look, something is wrong, something is not happening. Then you don't have enough time to do research, so you just get out of those positions. So here my concentration on Wipro has gone up 10 to 15%, 15 to 20%. At 20%, I would have definitely panicked and sold some shares. I would have made sure that with the dividend that I get, I buy something else, maybe buy a house, maybe maybe make a foreign trip, whatever. But that money would never have gone back into Wipro. That money would have gone into buying some other share which may have gone fat, right? Silverline maybe, and it would have gone fat. That is also possible. Or completely outside the industry, bought a bad share and that went fat. That's still okay. But again, now the concentration increases because the other parts of my portfolio are not going up at the same rate at which Wipro is going. So one good thing that I would have definitely done is taken the dividends and bought some other shares, and hopefully some of the other shares would have done well. Maybe I bought Colgate, P&G, Siemens, Cummins, Pfizer, or things like that, and that also started doing well. Then I would have been less worried about what Wipro is doing. But again, Wipro jumps up in valuation and becomes 18%, 20%, 25% of my portfolio. I would have sold and come back to 15%. So I would have kept on selling. But one good thing is, today, maybe after 40 years or whatever, that is 42, 43 years, I would have had maybe 100 crores worth of Wipro. That is for sure. I wouldn't have gone below that. But if the other part of my portfolio is worth say only 40 crores or 50 crores, then I would again be worried, because out of 150 crores, 100 crores would just be Wipro, and I'm not in management. Please understand the difference between Azim Premji having a concentrated bet in Wipro and you and me having a concentrated bet in Wipro. It does not really happen. So if you have a concentrated portfolio, understand there are a lot of disasters in the market which happened because of concentrated portfolios. So there is great logic in you not to have a concentrated portfolio. So if you take companies like Berkshire Hathaway, they say, oh, we don't take a concentrated, we have a concentrated portfolio. Actually, they don't, because any insurance portfolio cannot be concentrated. It is well spread out in Africa, Asia, America, wherever, right? That's how you would want to spread your risk. So what all can you do to reduce your risk? Never have such a huge concentrated position, so you will sell. You will also sell because maybe you needed money, or maybe you needed to buy something else. Maybe you needed to invest somewhere in some other company. I mean, if you were to get if you were to retire, I would sell my concentrated position at least on like an SWP, and do that into a systematic investment plan. I've done this for 4 or 5 promoters, saying every month we will sell 3,000 shares. because if you're sitting on something like 3 crore shares and you're now just an employee, you are a owner but now you're just an employee and you have maybe 18% stake or 17% stake, and the guy who bought you out is saying you cannot sell bulk, right? So you have that limitations, and you are continuing to get some new ESOP because you are now an employee. I'm just making assumption. Now don't get into, if you own 21% you can't get ESOP. I'm not getting into that, but you are getting fresh ESOP also, so you're building a fresh position. You have got to sell the shares that you have. That is the only way you can reduce your concentration risk. What else will you do for reducing concentration risk is maybe if you were let us take the SVB, let us take the Punjab and Maharashtra Cooperative Bank. Let us take Yes Bank into account. Yes Bank also closed down for a week, right? It can create a lot of stress for us. So increase your banking relationship, increase your mutual fund relationship. Don't have all your money in one ultra short bond fund. Have it in 4 ultra short bond funds. Reduce your risk by selling. If you've got an ESOP position, sell your ESOP and put it into a large cap fund. Right, a large cap fund, let's say with 70-80 stocks, that is a good way to diversify, or maybe a flexi cap fund, or maybe a balance advantage fund, depending on your risk profile, right? So do that. That's the way to reduce your risk. You cannot keep on increasing risk and say I will I will retire. Let's say you have or go and compare the standard deviation of the portfolio. If you have a single share versus having 50 shares, right, it dramatically comes down. Even from 1 to 5 itself it comes down, then 5 to 15 it comes down further. When by the time you go to 50 you have a much lower standard deviation than you would have had with a single share. So chances of me buying Wipro were not zero, because I have applied in NFOs before that with my father's money. Yes, we would apply for not very great amounts of money, maybe 5,000, 10,000, but 10,000 was definitely available. So out of lottery, if we had picked 100 shares of Wipro at 100 each, it would have been 10,000. And no, I would not have been tempted to sell it on listing. I did not sell any of my MNC shares on listing. I wouldn't have sold Wipro on listing. But you saw how I would have handled the concentration. So concentration reduction, standard deviation reduction are all definitely parts of risk reduction. So as an individual, what should you do? Like I said, increase relationship, build separate different sources of income, right? If one source of income stops, the other one picks up, the other one is also there, so you are not exactly starving, nor are you not busy the whole day, right? So I would even suggest slightly different insurance providers. Use one for the regular and another one for top up. Perfectly all right. Though of course you might think that having top up with the same company makes sense, because you know the papers have to be submitted only once. It's your call. But largely creating different sources of income, creating different, I mean, I invested in ULIP in 2001 or 2003, right? So I think 2003, and I'm benefiting immensely now because the amount has grown to a nice big fat round sum, and the whole thing is tax free. Today if I were to put that much of premium, it would be taxable. So one has to think of having all products and reducing risk, right? So because of my refusal to have so much of concentration risk, I could never have held Wipro from 10,000 to 700 crores. It is almost impossible for me to have held. I did not buy it, as a different thing, but even if I had bought it, I would have definitely sold. What about you? Please comment. Thank you.